Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and thank you for joining us today. My name is Sean Pang and I'm an investment strategist at Standard Chartered. We are recording this on the Friday, 22nd of January, and we have also just released our weekly market view titled What to Expect from Biden. As you can tell from the title, one of the key developments for markets this week was of course the inauguration of Joe Biden as US President, as well as incoming Treasury Secretary Janet Yellen's confirmation hearing before the Senate Finance Committee earlier this week. In our publication and podcast today, we will talk about the economic and market implications of the plans that President Biden has laid out, and also break down Yellen's comments during the hearing. To discuss these topics on today's podcast, I have with me Manish Jaradi, Senior Investment Strategist, and Abhilash Narayan, Senior Investment Strategist for the Private Bank. Abhilash and Manish, it's great to have you on today. So let's kick off today's podcast with a question first for Abhilash. So US President Joe Biden has laid out a rather ambitious economic revitalization plan for his first 100 days. Could you perhaps share more about the implications of these plans, both for the US economy as well as for markets?
Thanks, Sean. And indeed, the plan that Biden has revealed is quite ambitious one. Now, if you look at the plan, it includes another $1.9 trillion fiscal stimulus, vaccination for 100 million people in the first 100 days, and reversal of several Trump-era rules with an aim to build a more sustainable and green economy. But it's also important to acknowledge that parts of Biden's 100-day agenda, especially the contentious bailouts of municipalities and the state governments, as well as doubling of minimum wage to $15 an hour, appear ambitious at this stage, given the Democrats' razor-thin majority in the Senate. Hence, we think that Biden is likely to focus on easy wins in his initial days. First of all, we think that he would be able to get a majority of the proposed $1.9 trillion stimulus approved in the first 100 days, including another $1,400 in checks to most Americans, as well as support for smaller businesses. Now, these measures should help boost consumption in the coming quarters and therefore help corporate earnings. Now, if we move to the global level, these policies should reflect the global economy and support EM assets, cyclical and value-style equities, and currencies such as the Australian dollar. And if we take a step back, the growing outperformance of non-US equities compared to US stocks over the past month actually reflects this emerging trend.
Thank you, Abhilash, for the great summary. Indeed, the policy backdrop remains, fairly constructive for risk assets. So moving on to equity markets, we know markets have extended their strong run over the past week, and specifically, we have seen a strong rally in the Hong Kong and China market this year. Is the rally sustainable in your view?
Well, that's a question on the mind of a lot of investors, given the stellar rally we have seen in Hong Kong and Chinese stocks in 2021. Now, if you look at the key drivers, one of the drivers has been strong investor inflows. So since start of the year till 19th of January, the southbound fund inflows, which is basically inflows from China-based investors via Stock Connect to Hong Kong, have reached $24 billion. And to put things into perspective, that is almost 30% of the total inflows we saw last year, and we've achieved that within 3 weeks of this year. Now, from a technical perspective, the MSCI China is certainly looking a bit stretched. And if we look at valuations, while they're still cheaper than global equities, the discount of Chinese equities to global equities is lower than the long-term average of 15%. But on the positive front, we do see a number of positive factors which could support the rally. So firstly, the strong Chinese renminbi versus the US dollar has induced outbound flows from mainland China amid supportive government policy. And if we look at the past behavior, the Chinese institutional funds usually take 2 to 3 months to build meaningful positions. So we believe that any short-term pullback, if we see any, would be an attractive opportunity to buy on dips.
Thank you, Abhilash. So staying on China, but perhaps moving on to the bond markets, in recent months, Chinese authorities have been increasing their focus on debt sustainability and we have seen them implement a number of regulatory measures. Are these credit tightening measures in China negative for Asian dollar bonds?
Thanks, Sean. Maybe let me just recap some of the measures that have taken place over the past few months. So these measures have actually started with the 3 red line policy for property developers late last year. And this year we have seen a number of measures, including fines and suspensions on rating agencies, auditors, and banks involved in debt issuance of recent defaulters. So given these tightening measures, first thing that we can expect is that default rate in the onshore bond market is likely to remain elevated. However, if we look at past experiences, we think the Chinese authorities have the tools and the willingness to avoid default rates from spiking to a level where they threaten the broader market stability. So we see 2 particular implications for the Asian dollar bond market. Firstly, we are likely to see greater differentiation between weak and stronger borrowers as the onshore financing risk for the weaker borrowers rises. And secondly, we could see an increase in issuance in the offshore market, which could increase the supply in the Asian dollar bond market as a whole. So in the short term, these measures or these implications could lead to a temporary volatility in Asian dollar bond market, but we think that the impact is likely to be contained. So on a 6 to 12 month horizon, we still continue to like Asian dollar bonds, especially the high yield segment.
Thank you, Abhilash. So this next question is actually for Manish. As I mentioned earlier, incoming Treasury Secretary Janet Yellen had a confirmation hearing earlier this week, which was a highly anticipated event for markets. So what are the implications of Yellen's testimony for U.S. bond yields?
Thanks, Sean. In our assessment, at the testimony to the Senate Financial Committee earlier this week, Yellen indicated her support for further government spending to help the economic recovery. For bond markets, this raises the prospect of high bond issuance that could exert upward pressure on yields. However, Yellen also highlighted that debt servicing cost is a key metric to monitor and crucial for a sustainable federal budget. Market participants have largely viewed this as implicitly aimed at the Fed, soliciting their help to maintain low yields. The focus now shifts to the Fed meeting scheduled for next week. Investors are likely to look for a reaffirmation of the Fed's commitment to average inflation targeting, which would imply that interest rates would remain low for the foreseeable future.
Thank you, Manish. Just building on your response and moving on to currencies, we do expect the dollar downtrend to continue in 2021. On the incoming administration's dollar policy, however, Yellen actually noted that the United States does not seek a weaker currency to gain a competitive advantage. So is Yellen moving away from a strong dollar policy?
Well, U.S. currency policy is the remit of the U.S. Treasury. Now, just looking at history, in 1995, Treasury Secretary Rubin promoted a strong USD policy, and as a result, the US dollar soared by about 50% by 2001. Most recently, Treasury Secretary Mnuchin spoke of trade benefits of a weaker US dollar in 2018. Now, Treasury Secretary nominee Yellen said this week that markets should determine FX rates, and manipulation of FX rates for a trade advantage is unacceptable. The Biden-Yellen-Powell triumvirate has the potential to deploy a very large fiscal stimulus while containing funding costs. We see Yellen's comments as a strong tailwind to our weak US dollar 12-month view. Low US interest rates, rising deficits, and a recovering global economy suggests a cyclical dollar decline could be a natural market outcome of supercharged US policies. We continue to prefer selling into any US dollar rally in coming weeks.
Thank you, Manish. Abhilash and Manish, thank you so much for your time, and also a big thank you to everyone for listening in today's podcast. Stay safe, and please reach out to your relationship manager or check the SC Private Bank app if you would like a copy of our weekly Market View report.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.